The biggest insurance mistake you could make. If you do this one thing, you could end up losing your insurance and having to pay tax on your cash value. The most oversold, underperforming insurance of all time. All right, Tom. It's a pretty intense intros there, but basically the most popular thing I see out there is indexed universal life right now.
Yep.
And I think it's overhyped and underperforming and going to be a major problem, whether it's 10 years from now or 20 years from now. I know within 30 years it's going to be a major issue.
100%.
And 30 years isn't a long time when we're talking about someone's lifespan. Right. So, what do you see as some of the biggest reservations you have and concerns?
Well, let's give some history to it first. Whole life insurance, participating dividend-paying whole life insurance has stood the test of time for going on 200 years for some of these big carriers. Really, what happened with universal life became popular in the 80s when you could build a life insurance chassis around a money market-like vehicle that was getting 10 to 15%.
Right, and that was fixed universal life because interest rates were really high, and you could just throw millions of dollars into this thing with a tiny death benefit. So it was just a great way to get tax-free returns on your, instead of putting money into a CD or a bond.
Exactly. So, but the problem with that was these policies were designed based on interest rates in the double digits supporting their growth. So as interest rates began to fall into the 90s and then 2000s, VUL, variable universal life, became popular.
Because the fuel was the market, right?
And remember the
variable universal life.
Remember the market in the 90s? It was the new economy. It could do no wrong.
I got suckered. I bought a VUL in the 90s.
Yeah, I sold some. So, and that was the idea. Is so now we're not getting fixed rates that are that high, but we're going to illustrate the stock market giving you 15% every single year forever and ever. And then, of course, we saw, the big 3-year down market in 2000, 2002. And then what really killed VUL was 2008 when they said, it was the lost decade of investing, and now the whole promise of VUL was not there. So that what that kicked off was this new design, which is still the same policy. It's still universal life. It still has all the same mechanisms, but the investing strategy is basically a call option spread. But boiling it all down, the promise to a client is they say words like zero is your hero, because they have it on a year-to-year basis, you're guaranteed that your crediting rate is no less than zero, so the market can lose 40 and you get zero. Cool, right? That sounds good. And what they'll also say is upside potential with downside protection. That zero is the downside protection, but you have the upside, and you can participate in an index like the S&P 500 up to a certain cap. Right now, that cap is 9 to 10% most of the time. Not so long ago, I want to say 7 or 8 years ago, you could see 14 and 15% caps. So the thing
that has to do with the options budget, right?
It has to do with the options budget. So when you buy one of these, you're not actually invested in the index. You're the insurance company has essentially bought options on the market that captures the returns between 0 and 10%, and that's not free.
That's an option spread.
Yeah, call option
spread. Call is up.
Yep.
The market's going up, and an option spread is basically saying there will be a cap on what you can get. It's the difference between 0 and 10.
Yeah, so not to get too technical, but if people understand options, then they're buying call options for anything above and beyond today's current market value of the S&P 500, uncapped. It can go as high as you want, but that's expensive. It's expensive to buy that option. So to make it affordable for the insurance company, they also sell a call option at a certain number, like 10% up from the market, and that's how they can use their dollars to capture that. So I always say, yes, zero is your hero in one given year, but the cap is the trap. All right. When you buy an IUL, there are fees every single month. Right. There are insurance charges. There's premium expense charges. There's a lot that goes into a life insurance contract. So zero is not zero. Zero is a negative number. Sometimes it's a few percentage points. Sometimes these are leveraged policies where it can be a lot more than that. So a zero actually is a negative year to your account value.
Because of the fees.
Because of the fees. And then you have to catch up. So the problem is you can't catch up because of the cap. You can't then earn 20% the next year. Yes, the market, when it goes down, it has historically always come back up. But because of the caps, it's set up in such a way where your best case scenario, if you do all the gyrations and run it through your Monte Carlo analysis and all the possible things that can happen, generally speaking, the market loses value about once out of every 4 years, historically speaking. And if you go through all that math, you realize that your best case scenario is probably 6 or 7 based on that. And that's just your best case scenario. The insurance company has the right to reduce those 10% caps all the way down to 2% in some cases. They have complete control over
You'll notice it's a really long illustration in policy.
Yeah.
There's a lot of provisions and moving pieces.
And they have all the control. You haven't shifted any of the risk. They have all control over how that works. So it's fun to look at. It's fun to illustrate. It's a great sales pitch. But long term, your best case scenario is probably what you would have gotten in whole life anyway, with none of the risk.
That's the best case scenario. And so here's the thing. Are you better at mitigating risk than an insurance company?
That's the whole point of the insurance company.
So why are we then removing the risk from the insurance company and putting the risk on the individual? Like,
it makes no sense.
Right. So you can put the risk on the insurance company with whole life and get, but I've seen, people like Doug Andrews say that, oh no, I got a year where I got 100% on my spread, because he's talking about borrowing from the policy and getting whatever, or saying that there was a year where the cap was like, I see these astronomical, like crazy proclamations that aren't accurate. And they're not, if they are accurate in a very short window, they're not accurate in a longer window. And yet people are buying this because it illustrates good, because it looks good on paper. But if they look at the non-guaranteed side, combined with the guaranteed cost of insurance, which there's a difference between current and guaranteed cost of insurance, you'll see it always goes to zero, meaning your account goes to zero.
Right.
And that's a problem.
In all but the rosiest scenarios, that account value will eventually go to zero. And like you said to start, it's usually not 10 years down the road. It's 20 or 30. It's at a time when you're at
when you might need the death benefit.
Right. And when you're at an advanced age and it may be too late to do anything about it or step in.
So does it depend on company to company whether if you borrow, does that change your net amount at risk ever?
Typically, no. So typically, no, you're going to borrow against the contract, and that loan is going to come off of the death benefit or come off of the account.
So it's not going to change the net amount at risk. So that, does it negate any guarantees if you've borrowed or if you miss a payment? Because a lot of people are like, oh, I've got a no lapse guarantee, or I've got but if you miss a payment, doesn't it negate those guarantees in universal life?
Oh yeah. If you have a secondary guarantee universal life, where as long as you pay a certain amount, they'll guarantee a death benefit. Typically loan events will negate that.
So loan event can negate that, missed payment can negate that. So again, you're taking on all this risk. And I'm going, if you're going to invest in the stock market, invest in the stock market. Don't go do this option strategy inside of an insurance policy. People use my book, What Would the Rockefellers Do, and use Index Universal Life.
Yeah.
But the thing is, the entire book saying that the death benefit is a future asset that's going to replenish and be there for the trust. If you put an Index Universal Life in there, you don't know whether it's going to be there. You've negated the entire concept and created risk, which the Rockefellers believe they took their risks in their business, not with their insurance. Exactly. And yet we're trying to train people like, no, you got to stretch the dollar, get more because you've got this potential upside. But the problem is if it's capped at 10, the market doesn't go 9, 9, 9. And they're like, great, I just got 9% instead of 6. No, it goes up and it goes above 10 and it goes down, it goes below 0. And when you look in the middle, you like I talked to this guy at Indianapolis Life. Actually, my business partner Ray Hooper did back in the day, and he was like the inventor of this.
Yeah.
And he was like, it's not going to do what they're illustrating it. He's like, there's no way. It's statistically not possible.
It can't. The sequence of returns, risk, and retirement. We've talked about before. It comes into play in these contracts when they go down, or even they get credited at a 0. It's not 0; it's less than that. So because of those fees, it's almost like draining money out of a retirement account, like you taking money out of your retirement account and making those bad years worse. But here's my overall take on it is, and I try to be fair because I think most advisors that are selling this aren't trying to do wrong. They are trying to help their clients. There may be a lack of understanding, but the way I paint the picture is this: I call it the art of life insurance. I've talked about with you before. There's 3 things that life insurance does really well from a diversification standpoint. One is access. You can access this money at any time without penalty, unlike a 401k or a retirement account. And a big one is taxes. You actually have basically an unlimited tax wrapper where you can multiply money by many times over the course of your life and never owe the IRS a dime on it inside of these contracts. It's one of the last great tax advantages available to everybody. But the third one is risk. That's the R, the ART. So the risk. If you buy a VUL, you're effectively investing in the exact same thing you can buy in your own in a mutual fund or an ETF, and you're just putting a better tax wrapper around it. You haven't mitigated any risk whatsoever. And in fact, there's more risk because of the rising mortality charges in there. Same thing with traditional universal life we talked about. Same thing with IUL. None of the risk is mitigated. With dividend-paying participating whole life insurance that's backed by a general investment account, which is largely a giant bond ladder, Through the life insurance contract, the company has guaranteed away all risk. In fact, they've guaranteed not only is it
contractually even,
and they've guaranteed that your cash value must go up every year. The only question is how fast do they enhance that with their dividend. But even if they don't pay a dividend, it's still going up every year. So think about that. If you can get bond-like returns over time, and you will because that's what they're invested in, that's what you have historically gotten. If you go back in time, there's data on that. If you can get bond-like returns, but none of the volatility, none of the risk, what you just created is a better risk-adjusted return. Like this is what they pay the multi-million-dollar salaries on Wall Street to the quants to figure out is how do we, for the same level of risk, get outsized return? You won't get that with life insurance. It's invested in a big portfolio of bonds that you could do yourself. Or how do we, for the same level of return, minimize the risk? And if you can improve that ratio,
that's what you can do.
Whole life can be a better, more efficient allocation toward conservative bond-like vehicles. And then go shoot for the stars with your investments outside of life insurance, with tax efficient or other strategies.